Let's get into it today. We're going to have a special guest and we're going to talk about Fed rate cuts. Will they happen? Will they not happen? What is the market going to look like year end? My name is Paul Barron. Welcome back into the show. Let's get started. I want to thank our sponsor. That's iTrust Capital. This is where you guys can go to get up your idea of a crypto IRA. And the cool thing about iTrust is it's very easy to set up. You can also transfer IRAs into iTrust. So just visit itrustcapital.com. Whether you're into building out a portfolio in your IRA or just locking in on things like gold and silver, all of that very flexible within their platform. You get a $100 funding reward if you use our link, so it does help the channel. Thank you so much for all that good stuff. All right, so I want to jump to a clip real quick. This is of our guest today, and it's his insights to take a look on where the risk markets are going. Take a look.
The risk asset is the treasury bond market. It's not stocks, it's not gold, it's not Bitcoin. And that's exactly what the market's telling you today from a year-to-date performance perspective. There is a geopolitically driven supply-demand imbalance in the treasury market. We have less demand and more supply, and neither political party here in the United States of America has any real political will to fix it. The best way to be exposed to financial market risk, certainly throughout the duration of a four-turning poly crisis, is via risk assets, because there are very limited levers that the sovereign can pull to get itself out of this mess.
All right, so bringing in the real Darius Dale coming in, and no longer a clip. How are you, man?
I'm great, man. It's great to be back, man. Handsome guy, huh?
Nice to see you. Nice to see you. Hey, listen, that was some pretty good statements there. I think you were kind of positioning the markets around this. Let's dive in a little bit deeper on this. This is a Kobe point that they were hitting on, kind of in line with what you're talking about. U.S. Treasury posted $291 billion in budget deficits in July, second largest of any July on record. $27 billion budget surplus is what we're looking at terms right now. Also, in terms of government spending, surged 9.7. This is year over year, so another $630 billion, so second highest since January. All of these macro environments continue to put a lot of pressure, Darius, on the economy, but at the same time, we've got a lot of investors that are saying, what do I do? What do I do? Where are the plays right now? Extend a little bit further on your analysis.
Paul, well, thanks again for having me on the program, brother. Appreciate you. In terms of, so you know what my answer to that's always going to be KISS. Obviously, stocks go Bitcoin, risk stocks go Bitcoin. But the reason we believe that's the case is because we ultimately identified that geopolitically driven supply and demand imbalance in the treasury bond market a couple of years ago. And every step that the both administrations have taken thus far tells us that A, that is likely to persist, and B, the only way we're going to fix it or resolve it or even address it are things that are likely to cause the price of the equity market, the price of the gold bullion, and price of Bitcoin to go much higher in price. And obviously our clients have benefited tremendously from that over the past few years.
So easy, keep it simple. I think, when you look at those because this right now, I think a lot of investors are trying to position around this. And in some cases, they get a little cute with how they're trying to play their portfolio, which is where mistakes usually happen. I want to go to this clip here. This is Scott Bessent talking about how much money is being taken in on tariffs. And I want to ask you, think about this, of how tariffs are going to affect the market. Let's take a look.
I think August, September is going to be a very good test. I've been saying that I think we can take in $300 billion, and as the Treasury Secretary, I like to be conservative, but there's a chance that I'm going to have to substantially upgrade that number. And Maria, the way to think about it for your viewers is every $300 billion is 1% of GDP. We were left with a mess. The deficit to GDP, 6.5, 6.7%, highest when we were not in a recession, not at war. So just the tariff revenue can bring that down into the fives, which fits with this administration's plan of getting the deficit to GDP back into the threes, the long-term average, before President Trump leaves office.
All right, so Scott Bessent kind of laying out his plan there of how he thinks this can be corrected. Do you think that tariffs are going to have any impact on what they are trying to do in D.C.?
Great question. So let me answer that in two ways, because both are very important for investors. So on the deficit reduction, so I've known Scott for many years. He's a former client, very serious man, has very big ambitions with regards to the fiscal coffers and fiscal health of the United States. It's highly unlikely that we see tariffs alone make a material dent in terms of putting us on a sustainable fiscal trajectory. In fact, when you look at the July monthly Treasury budget statement, we analyze the budget statement. One of the ways in which we analyze it, of a myriad of ways, but one of the more important ways is the annualized fiscal year to date, year over year change. And when you look at that, inclusive of tariff revenue that's tracking up 111% year to date, we're not quite annualizing at 300 billion in revenue yet. We're about halfway there. But even with halfway there, we still have a budget deficit that is up about $122 billion on a annualized fiscal year to date basis year over year. And so that reminds me and to remind investors that the drivers of the deficit, particularly the categories that our friend over at Forest for the Trees, Luke Groman, his true interest expense metric, Medicare, national defense, net interest, and Social Security, that's really what's driving the budget deficit. And that stuff's been compounded. One, it's about 2/3 of the overall federal expenditures when you add all those four categories up, and on its way higher, by the way, as a function of the one big ugly bill. Those things are compounding at plus 11, 12% year after year after year after year. So we have to raise all this tariff revenue just to sort of maybe hope to offset the growth in those categories. And oh, by the way, we have a big fiscal, a tax cut program that's going to start to hit the tape in early 2026 as well. So there's a lot of running in place, if you will, if you think about this from a retrenchment standpoint.
With that being said, obviously we saw the Genius Act go through. Stablecoins are now part of maybe Bessent's long-term plan here, because this is in some way a way to shore up the dollar. Stablecoins, digital tokens pegged to a national currency. Most often right now it's the US dollar. 90% of all stablecoins right now are backed either by cash deposits or short-term US treasuries. That's going to potentially prop up the treasury market itself. So when you look at Bessent's vision, every stablecoin minted worldwide now becomes kind of a new funding of the US government. He states it there. I mean, because this is now, stablecoins could go into all sorts of countries, a lot of, second-tier markets that have been looking for dollars for a while. Now they get them, and of course, that backstops these US treasuries in terms of the asset. How would that make any difference in his plan to try to right the ship there in DC?
It's not going to right the ship, but I think it's a brilliant strategy, and it's consistent with our Paradigm C-inspired view that the administration would carry on and continue our fellow Janet Yellen's dovish net financing policy. So so when you have a fiscal problem, there's a bunch of levers governments tend to pull. The primary levers are try to cut your way out of the problem. You can try to grow your way out of the problem, which is what the Trump administration pivoted to on April 9th. And then now, or eventually you're gonna have to wind up printing your way out of the problem. That could be years down the road. Part of that, one of those levers that you can pull in the context of growing your way out of the problem is shifting to dovish net financing policy. Right now, T-bills are about 21% outstanding of total marketable treasury securities. The percent of marketable treasury securities that mature in the next calendar year is about 31%. Those numbers were as high as 35% and 48% respectively in terms of those respective time series. So we know we're going to continue to finance on the short end of the curve. So the Genius Act is in fact genius in terms of meeting the market in terms of demand, meeting the supply that they were going to bring to the market, where the demand with growth in the market is going to be, and that's going to artificially depress yields. And I'll take the other side of one of the things you said, respectfully, Paul, is that when you capitalize on the short end of the curve, what happens is you roll over FX hedges much more quickly. And so the likelihood that we see a sustained bear market in the dollar is a lot higher. The probability is much higher when you capitalize on the short end of the curve as it is when you capitalize on the long end of the curve.
Okay.
Yes.
So with that being said, and you look at PPI just coming in much hotter, rises to 3.3, expectations 2.5, core PPI going to 3.7, up from 2.9 on expectations. How does this play into this? Because the Fed is now in a really, really tight spot. You've got interesting data coming in. You've got pressure from DC, the Trump administration, continuing to pressure Powell. All of this, does the macro environment change at all right now, at least in the near term, which is September coming up?
Yeah. So, I mean, in my opinion, it can change if the Powell Fed commits to making its fifth major policy mistake. Recall, they were too slow to ease, or they over-tightened in 2018. They were too slow to ease in 2020. They were too slow to tighten in 2021. They were asleep at the regional bank supervision wheel in 2023. And then in our opinion, we think they're too slow to ease here in 2025. They're anchoring on future values for the most lagging indicator of the business cycle to set prospective monetary policy with. I don't even care what the inflation numbers are. That is a policy mistake, especially in the context of the worst part of the U-shaped economy that we've been calling for. We are now in the worst part of the U, which is the bottom left side of the U. And so we need policy support to both shore up confidence among investors, but also to shore up confidence among business builders and employers like myself that, hey, we can actually ride our way through this rough patch that's caused by the advent of this tariff shock. It's not a durable shock. It's just a change that's going to cause a lot of, problems and one-time price adjustments across various sectors of the economy. And you need the Fed to play ball in order to ride us through, to help us ride through that. And so in our opinion, you see some volatility if they do not.
Okay, so that's going to lead to some interesting markets. Tom Lee, I don't know if you follow Tom, but he, of course, Fundstrat. He's jumping in. He's one of the goats. Well, right now he's the number one the number one major league investor out there. Number one since late 2022, every dip has been bought. Number two since late 22, every dip has been bought. And number three since late 22, every dip has been bought. And he's talking about it again, buy these dips as we start to see them come in. Do you agree with where his frame of reference is right now? Because he's very bullish on where the market could be going.
Look, I don't think there's an institutional investor on global Wall Street that's been more bullish than Darius Dale since May 9th of 2020, or May 3rd of 2025. Tom Lee has joined me in this raging bull.
Darius was the OG. Tom Lee came to the party late. Okay, I like it.
Let's be. I love Tom. He's one of the goats. But let's be honest here. We authored the Paradigm C view back in late April. We essentially said, hey, the administration is pivoting from cutting their way out of the mess to growing their way out of the mess. You need to be very, very bullish. This is going to last multiple years. And so, obviously we've seen a wave of upside capitulation across global Wall Street for institutional investors and obviously retail investors as well to get aligned with our view. And we expect that view to persist. Even if we get some, policy mistake driven volatility in the next couple of months, you still got to buy that dip because there's a whole cohort of investors that are not aligned with our long-term structurally bullish Paradigm C view.
What do you make? Okay, so so far we're in agreement. I'm following along with I'm drinking the Darius Dale 42 macro milk.
I like being in agreement. You're a smart dude, Paul. This is great.
I'm just following the smart people. That's all I do. But Lynn Alden is another smart person, and she kind of goes on right here, and she's saying, let's see what happens with the BLS data. Currently stands foreign producers in aggregate haven't followed lower prices to offset the tariff expenses paid by U.S. importers. So we're probably going to see some adjustments within that right now. Will that possibly cause some struggles for Powell right now, at least on some of the data that could still be coming in with inflation maybe starting to tick up slightly here before his September Fed meeting?
Yeah, so appreciate you highlighting Lynn. I think she's also one of the GOATs. Amazing. The one thing I would say we can't read too much into anything we've seen reported thus far. And the reason for is we've seen, one, tariff volatility. We've seen tariff rates go up and down as a function of the negotiating process that we've been involved in. Two, we've seen a tremendous amount of front running of inventories prior to certain tariff announcements for different sectors and different countries. And so there's a lot of non-tariff goods sitting in inventories and warehouses and retail and on retailer shelves around the country. So we haven't really seen the pinch yet, both in terms of corporate operating margins, but also in terms of consumers. That pinch is coming. We know it's going to come. It's not going to come all at once. It's going to come over the extended period of time across different sectors of the economy. So it's going to feel like a slow moving, slow building wave of inflation. And ultimately it's going to be playing hot potato. We're going to see the import price go in a little bit. We're going to see operating margins go down a little. We're going to see inflation go up a little bit. And the net result, in our opinion, is an economy that should make it through the bottom of that U-shaped economy unscathed, just in time for the boom that we're likely to see in 2026.
Okay, well, listen, I mean, guys, we're giving you some of the best alpha that is out there right now. Pay attention. I'm just telling you, pay attention to what's being said right now. So we're gonna get into some predictions here on how the Fed's gonna handle this, what the 2025 looks like year in and next year. So stick around for this. Darius, before we do that, I wanna go to the CNBC clip, and they're talking about a 50 basis point rate cut. That's kind of crazy to hear, but listen to what they had to say.
You can't, they're not just concrete numbers. And 1 to 3% on inflation is about the best, really, that agency can give you. And if employment looks weak, you should cut.
I completely agree with that. The worry is that these job numbers got revised down very big, unusually big. And before that, we had a disconnect where GDP numbers have been weak, about 1.1% for the first half of the year. Jobs number has been strong. And then the jobs data got revised towards GDP. And so we now know that the economy has been growing weaker. And so a 4.33 Fed funds rate is just too high. And the market will always tell you what you should be doing. And we see the inversion at the front end of the curve, which is over 50 basis points, tells us that we could easily do a 50 basis point makeup cut because the data had been wrong in the past without disrupting anything at all. So it seems like pretty much a no-brainer to me.
All right, so this goes back to my thesis, which was last month saying, because I was on record, I just simply said, I think we deserve a rate cut in July based on the data we're getting. He just said makeup rate cut. So if we've got potentially that in play, September, what would Darius Dale be doing if he were running the Fed right now? Give me a quarter, give me 50, how would you play this toward the end of the year?
Darius Dale or his former client, Treasury Secretary Scott Bessent, are running the Fed right now, the Fed funds rate would be below 3%.
Okay.
There's no reason at all 4.5% Fed funds rate for a variety of reasons. Well,
that goes back to what Scott said. He said a full 1.5 is where it should be. Yeah.
Well, again, the man's a former client. The point I'm making is that the two points I'm making. One, the data had deteriorated enough to support a 50 basis point cut in September. Recall that we published a op-ed on the evening of the July FOMC meeting saying, hey, you guys made a policy mistake. This is another policy mistake. Fast forward 2 days later to the jobs report, then everyone else agrees finally. So kudos to me. But more importantly, this is a Federal Reserve institution that is operating with a legacy inflation target of 2%. That is asinine and does not make sense for today's economy. There are so many structural reasons why their policy is too tight because of their arbitrary 2% inflation target. And we've been preaching very hard to catalyze regime change at the Federal Reserve. We think it's coming, and KISS is very, very well positioned for it.
All right, so I'm going to show you this tweet right here. It's basically that, the cabal of 12 unelected, unaccountable people that's pricing money right now. What do you think is going to happen? I got to get you on record. What do you think is going to happen in September? What happens in September?
I believe there's going to be a 25 basis point rate cut. Until they get that Fed funds rate to at least 3%, I would say probably 2.5%, they're making a policy mistake. There needs to be significant regime change at that institution.
Wow. Okay. Well, there you guys have it. Are you? Yeah, for sure.
Whether you guys who are listening to me talk right now, whether you position appropriately for it or not, it's coming because this is one of the easiest levers any administration around the world can pull to help claw their way out of a debt problem. It's coming. Position for it. KISS is well positioned for that.
All right. I have two more questions here because we're trying. All right. So let's say Powell is completely ignoring everything that he's being fed right now, and he simply says no rate cut. What is the chances of no rate cut through the end of the year? Do you think it's very low?
I think the chance of no rate cut through the year is actually middling probability, so probably 50-50, because you have a guy who's determined to protect his legacy. He let the inflation genie out of the bottle by overcooking monetary policy in the context of historically expansionary fiscal policy in 2020 and 2021, and now he wants to retire as someone who put it back into the bottle. Well, newsflash for you, Mr. Powell, if you had just been running sound monetary policy the whole time, we wouldn't be in this mess, and you would just be able to set credible, thoughtful monetary policy for today's economy, not your future legacy.
He's projecting Volcker. That's what he's doing. He's projecting. That's
what he is.
Yeah, exactly.
Easeaholic.
I like it.
He's in the 12-step program for monetary policy.
12-step program. I love it. End of year, bullish, bearish.
Raging
end of year.
You have to buy any dip as long as we're in paradigm C. Until somebody hears me say we're going back to paradigm B, we're going way higher in stocks, gold, Bitcoin, and KISS.
All right. And then last point, 2026, do we start to see a fall off in the market, or do you feel like 2026 is a big year for investments?
I think the biggest test for the market over the next 12 to 18 months will come in the midterm elections in 2026, because that could potentially truncate the levers that the Trump administration can pull to maintain paradigm C. if they get forced out of paradigm C by fiscal policy maker, by Congress essentially, or by Congress that becomes less amenable to their stated desire to enact regime change at the Fed, then we can have some serious problems from much higher prices.
Yeah, for sure. All right, listen, guys, we'll get Darius back on. He's always dropping bombs out here on the show. I love it when you're on. Thank you so much for coming on today. We appreciate it, Darius.
Always a pleasure, Paul. Appreciate you, brother.
You bet. All right, so you guys, we will get more of this for you because this is going to be a heated next few months with everything that's happening with the Fed, what we'll see in the markets, obviously Bitcoin hitting its all-time high. If you're not part of our Diamond Circle, get in right now. It's our own special newsletter that goes out to you guys absolutely free. And of course, follow me out there on X @Paul Barron. We'll catch you next time right here on The Paul Barron Show.